Welcome to WorldView Today, where we uncover the forces shaping our global future. Imagine a world where trade wars redraw economic maps and political purges signal hidden power struggles. Today, we dive into the escalating clash between the U.S. and China, a battle of tariffs, currencies, and influence that could redefine the global order. Stay tuned because this story affects us all. The Chinese economy, already grappling with significant headwinds, now faces a formidable new challenge from the United States. President Donald Trump has escalated trade measures by proposing an additional 20% tariff on top of existing duties on Chinese goods, bringing the total tariff rate to approximately 40%. More recently, an additional 25% tariff has been introduced, pushing the cumulative rate to a staggering 65%. This dramatic escalation effectively slams the door shut on China's ability to profit from exports to the U.S., its largest market. On February 24th, President Trump announced a bold policy. Any nation purchasing oil or natural gas from Venezuela will face a 25% tariff on its trade with the U.S. This move targets Venezuela, a country Trump has repeatedly criticized, accusing it of sending tens of thousands of violent individuals across America's southern border. Venezuela heavily relies on oil and gas exports, with China as its primary customer. In 2023, China accounted for 68% of Venezuela's total oil exports. With this new tariff, China now faces an additional 25% duty on top of existing tariffs, aligning with Trump's campaign pledge to impose a 65% tariff on Chinese goods. The consequences for China are profound. Factories dependent on U.S. exports may find it unsustainable to remain in China, prompting some companies to relocate manufacturing to the U.S. This aligns with President Trump's broader strategy to reduce America's national debt and revitalize its economy. Critics warn that these tariffs will raise costs for American consumers in the short term, but supporters argue that the long-term benefits, bringing manufacturing jobs back to the U.S. and reducing reliance on foreign supply chains, will outweigh the initial pain. Trump's vision, they say, reflects a deep commitment to America's economic independence. The tariff strategy extends beyond China. On February 13th, Trump signed a memorandum on reciprocal tariffs, instructing the U.S. Commerce Secretary to assess tariffs imposed by other nations on American goods within 6 months. Countries with significant trade imbalances, such as China, Canada, Mexico, Germany, Brazil, India, Japan, South Korea, and Vietnam, are likely targets. The U.S. is also addressing non-tariff barriers and currency manipulation, with China accused of practices like mandating joint ventures with state-owned enterprises and subsidizing key industries, which disadvantage American businesses. Globally, nations face a choice: lower their own trade barriers to maintain favorable relations with the U.S., or risk retaliatory tariffs. Adding to the pressure, Trump has imposed a 25% tariff on automobiles and auto parts not manufactured in the U.S., effective from April. This policy hits major exporters like Canada, Mexico, Germany, and Japan, aiming to lure automotive production back to American soil. The economic fallout is already evident. The Canadian dollar and Mexican peso are weakening due to their reliance on auto exports to the U.S. For China, the impact could be even more severe. A Bank of America analysis predicts that, in a worst-case scenario, the Chinese yuan could depreciate by 21%, potentially reaching an exchange rate of 8.6 yuan to the U.S. dollar. This devaluation would compound China's economic woes, further eroding its export competitiveness. Amid these external pressures, China faces internal turbulence. Reports indicate a significant purge within the Chinese military, with over 100 senior officers removed between mid and late month. This could signal either an internal power struggle or a move by President Xi Jinping to tighten his grip on power ahead of key political events. The opacity of China's political system leaves the situation unclear, but the implications for its domestic stability and foreign policy are undeniable. As the U.S. and China engage in this high-stakes economic and political chess match, the world watches closely. The outcome will ripple across global trade, currency markets, and geopolitical alliances, shaping the future for years to come. What is the impact of U.S. tax policy on China's manufacturing industry? The U.S. tax policy under President Trump has significantly and directly influenced China's manufacturing industry through the following mechanisms. Closing the export route. With tariffs reaching a cumulative total of up to 65%, Chinese goods have lost their competitive advantage in the U.S. market. This has diminished the incentive for companies to maintain manufacturing facilities in China, particularly when their primary customer base is American. Relocating supply chains. To circumvent the burden of these taxes, many companies are opting to relocate from China. Some are returning to the U.S. to leverage tax incentives, while others are shifting operations to Asian nations such as Vietnam and India. Decline in investment and employment. The loss of U.S. orders has compelled Chinese factories to scale back production or shut down entirely, resulting in rising unemployment. This impact is particularly pronounced in manufacturing sectors like electronics, automotive, and consumer goods. Pressure on exchange rates and production costs. The depreciation of the Chinese yuan has triggered financial instability. In response, the Chinese government has resorted to subsidies and non-tariff barriers to retain businesses, though these measures may aggravate the situation over the long term. Ripple effects on industrial cities. Shenzhen and Shanghai, heavily reliant on exports, have borne the brunt of these policies. Economic data indicates a rapid downturn in these cities, adversely affecting real estate, employment, and consumer spending. In summary, China's manufacturing sector is facing a dual assault from U.S. tariffs and internal challenges, including demographic shifts, financial strains, and capital outflows. These tax policies have placed China's role as the world's manufacturing hub under serious threat. If you found this analysis compelling, please support WorldView Today by subscribing, liking, and commenting. Your engagement fuels our mission to deliver in-depth coverage of the events shaping our world. Thank you for joining us, and we'll see you in the next update.